Hey everyone, thanks for attending. I'm Ashish Jain, I'm the CFO at Slope. This panel is very near and dear to my heart because our company we lead with embedded finance and we are developing software solutions. So I was very excited that my friends at Fintech Nexus allowed me to moderate this panel. So in terms of this panel, this topic is, I think, very much top of mind for startups, publicly traded companies, and investors. We continue to see strong intertwinement between embedded finance and software providers, and much of it is customer-driven needs. Recently, BCG did a study amongst SMBs where greater than 50% of the SMBs in 5 of the top 7 verticals indicated a willingness for more financial service solutions from their vertical software providers. The delivery of these embedded finance products, whether it be deposits, lending, payments, and issuing, differs across the ecosystem. Some lead with embedded finance, and then we've seen some companies such as Adyen, Shopify have launched as software payment solutions, and then now I've added embedded finance offerings. With this panel, we're really fortunate to have a great group of folks. I like to think of the companies that they represent as embedded finance enablers and distributors within the ecosystem. So with that, let me introduce each of the panelists that we have on. They all have really impressive backgrounds. So Erica Khalili is a Chief Legal and Risk Officer and co-founder of LeadBank. Previously, she spent over 6 years at Block, formerly Square, serving as Deputy General Counsel and General Counsel for Square Financial Services, Block's internal bank entity. Erica led the cross-functional efforts for Block to obtain a de novo ILC charter. No easy task, having worked on that a little bit at one of my former companies, SoFi. So really impressive background. Before joining Block, Erica worked at Mayer Brown. Next we have Sachin. Sachin is the co-founder and CTO at Ocelar. It's a no-code real-time decision engine for fraud prevention and risk mitigation. Before Ocelar, he was at Facebook, now known as Meta, for 11 years, where he led several organizations responsible for building one of the largest private cloud deployments, Facebook Live, and the back end of Facebook Messenger. I'd also like to highlight that Sachin is now the father of a baby girl. So just 3 days ago, he had a baby girl. So I brought back, yeah, and we're super excited for him. And I was telling him before the panel, my son just turned 8 yesterday, and things definitely fly by very quickly. Next to my left, we have Paula. Paula is the VP of Product Management and Business Solutions and Innovations, covering banking and insurance accelerators and connectors. She's been with Fintech OS for over 4 years and also leads key customer engagements. Paula is proud of being able to influence how Fintech OS can support customers in their journey to transform and become more digital. Before joining Fintech OS, she worked on sales and strategy at various roles at some amazing corporate clients such as Vodafone and Oracle. And then lastly, we have Jeff Charles. Jeff Charles is VP of Product at Ramp, where he leads Ramp's product vision, driven by a belief that software should be working for people and not against them. Jeff's product strategy focuses on helping businesses save time and money. To date, products he and his team built have saved businesses over $400 million and currently manage an impressive $1 billion in spend per month for over 15,000 businesses. So an amazing panel. I'll hand it off to the panelists a little bit, starting with Erica, to talk a little bit about LeadBank and how they serve this ecosystem.
Sure. Thanks, Ashish. And thanks for inviting me to be on the panel. I know lawyers and regulatory compliance people aren't always the biggest page turners, so I'll try to keep it interesting. Lead Bank is a full-service institution based out of Kansas City, Missouri, and we are focused on supporting the fintech and digital assets ecosystems by having a technology-first approach, but also, and especially in this regulatory climate, I had to drop that one in, making sure that we're exemplary across all verticals, not just tech, but also compliance, and really feel like a partner to the fintech and digital assets providers that we partner with. So we're super excited about what we're building and also the future of embedded finance generally.
Thank you, Ashish, for inviting me to the panel. And contrary to what the slide says, I'm not Ashton Braun. I'm Sachin Kulkarni from Oscillar. Oscillar is a no-code AI-powered decision engine used for credit underwriting, both B2C and B2B. So it's a one-stop shop for fetching data across multiple sources. You can use our own ML models, cash flow scores, and so on. And so it becomes very easy to launch new products in the underwriting space. We also take care of fraud prevention and have our semi-supervised machine learning approaches for account takeover, collusion fraud, transaction monitoring, synthetic ID, and so on. So it's a one-stop shop for both underwriting as well as fraud. Happy to talk more to this.
Right, so Fintech OS is actually a fintech enablement platform that today is used by more than 50 financial institutions globally to actually launch innovative products that are data-driven to market, to open new distribution channels, and obviously create new revenue streams for both traditional players in the landscape, either we are talking about banks or even insurers, or really fintechs or any company that would like to actually complement their offer with financial services like retailers, telco companies, or big tech companies as we see that are entering the space. So quite interesting to be part of this panel today on embedded finance. And also with Fintech OS, it's not just launching innovative products to market, but also integrating the ecosystem. So leveraging partnerships with the fintech players that offer new data structures, new data information about customers, and hyper-personalize their experience throughout their preferred channels in the end. And then you can also service those products in basically a fintech infrastructure layer that goes on top of your existing core systems, so it reduces the risk and you can both innovate and modernize your legacy systems. So thank you.
And lastly, Jeff?
Yeah, Ramp is a corporate card and spend management platform designed to help businesses save time and money. We started with a corporate card that automates your expense reports. If anyone here is doing expense reports, it's a much better, delightful experience, and we scaled to own the rest of the financial operations stack, including bill payments, accounting automation, financing, et cetera. So we're located in New York City, and over the last 4 years, we've acquired 15,000 customers and continue to innovate on the side. We purchased a lot of financial software, so interesting to get the discussion going around what we look for and how we partner with embedded fintech players.
Perfect. So why don't we get it going with you, Erica? I mean, you were at Square for nearly 6 years. This is a company many startups, of course, admire. Talk to us about the approach Square took to build customer loyalty through financial products, and also how you were able to build both hardware and software solutions.
Yeah, I think taking it back to sort of first principles is always looking for the problem to be solved. And I think that's something that I've seen immense success at Square, but also at Lead Bank, around how finding that niche problem and rethinking everything from a why does it have to work this way, taking it back and feeling that immense customer pain is sort of the genesis of where it all starts, is what is the problem to be solved and how can we make this a smoother experience? And I think that's something Ramp's also probably seen. I'm a Ramp customer, by the way, and our CFO's in the audience, so she's a big fan as well. But I think figuring out how to make that thing that people hate to do, the thing that people don't understand, the thing that seems obtuse and opaque, digestible, easy to understand, and then building it in a manner, and this is kind of how we've approached it at LEAD, as a partner first, in a modular manner. How can we solve problem A? Okay, we feel good about that. How does that then flywheel into problem B, problem C, problem D, and creating that, and I hate the word stickiness, but the stickiness of the ecosystem effect, where you then become intrinsically tied to your customer base, because when they thrive, we thrive. When they grow, we grow. So the fundamental alignment of interests is always there, but you really have to kind of start with that first problem to be solved, but always have that kind of 80-20 mindset where 80% is the focus on getting through sort of problem A, but 20% you're always thinking about, okay, what's problem B, what's problem C, and building it in that way to kind of ensure that you're growing in the way that there's a demand and what your customers are looking for. And I think we've seen that all across fintech, embedded finance, digital assets. It all goes back to those first principles. And then, making sure that the partnership mentality just permeates through everything.
Mm-hmm. And Jeff, somewhat similar to Square, Ramp is also targeting small businesses and has broad aspirations in spend management. How has your approach been different as you lead with a charge card? And then also, what enablers or third parties in the ecosystem allowed you all to scale so quickly?
Yeah, so totally agree with Erica. I mean, if there's no pain, there's no market, there's no buyer, there's no ability to pay or willingness to pay. I'll answer the second part of your question, actually. So Ramp, 6 months after incorporating, we basically launched our product, and we did so with 3 engineers. When you think about the basic version of spend management, it's a KYC, KYB platform, so you buy that, right? You partner with that. It's a card issuing platform, you buy that. It's an internal tools platform, you buy that. It's a deployment platform, you buy that, and you just wire it all up together. You put a nice little bow on top, nice little color scheme, and you launch, right? And you try to solve a customer pain point. So with embedded players, what we look for, typically we try to partner with newer players that will partner with us and listen to our feedback very closely. And we're willing to pay quite a bit of money and then renegotiate as we scale, right? So that's a little bit about what we look for, and what we don't buy are things that we want to be our main competitive advantage. But realistically, creating a physical card that has a chip and a stripe and sending it to a customer is not something we want to innovate on. What we want to innovate on is the user experience and the automation and how we wire all these things together. So that's a little bit of how we went so quickly. And I think, as you think about your target segment, startups have one goal, and that's just to survive and to find product market fit. And so we'll do whatever we can do to reach that.
Got it. And Sachin, so in terms of some of the points that Jeff highlighted, Ocelar is just out of stealth, and you've been working to address and help fintech companies scale in some of these efforts like KYB, KYC, decisioning. So talk to us about some of the core tasks that you all are focused on versus incumbents in the space as well.
Yeah, absolutely. So before we started Ocelar, we actually talked to 100 different risk leaders across different sizes of companies, different verticals, to understand what the pain points were and how we could make their lives easier. Going back to sort of, there has to be a problem to be solved. And so what we figured out is there were 3 large problems that many of the founders and key execs were running into. They wanted the risk teams to be autonomous. They were depending quite a bit on engineers to make small changes, and nobody likes to be blocked, nobody likes to be slowed down, and they weren't able to experiment well enough. So that was one big problem. The other one we saw was not having access to the right data at an appropriate time in the decisioning process. That is, I think, self-explanatory on what happens there when you don't have that. And the third one was machine learning not catching up, like models not being able to target that particular niche, or not finding new fraud patterns, not being able to deal with newer markets, new types of users, new products that they were wanting to go after. And so we decided to target all 3 of them, and of course in different ways. So we figured out the best way to make risk teams autonomous is to provide them a full end-to-end no-code platform. That way they don't have to depend on engineering, they can make the changes they need. They have full power of what the engineers were offering them without having to be blocked on them. So that was super important. The second one, for the data, we decided it was necessary to capture the entire customer journey and then do risk assessment on each part of the journey, but creating a 360 view of a user. This involved pulling data, KYC, KYB at the beginning. For underwriting, this would involve credit bureau data, but also alternative data. And so this could be Plaid, which is the sponsor of this. So like bank transaction data, could be car transaction data, accounting data, tax data, so a variety of these, but make it available at every stage of the process and be able to automate that entire process. So being able to do that in an effective way was super important. And then the machine learning approach. With unsupervised machine learning, there are quite a bit false positives, and that's a problem that many folks that use unsupervised would run into. With supervised machine learning, it requires a lot of labels. And labeling is the bane of existence for anybody that wants to train ML models. So we came up with a new approach, semi-supervised machine learning, that doesn't have the high false positive rate, but doesn't require very many labels. Like with very few labels, you're able to get going. And so that was actually very effective. This way, when your company is pre-scale and you don't really have as many labels available and don't have people to do the labeling either, you are still able to get excellent value out of our models. And once you're post-scale, you don't have the time to spend on labeling everything. And you, of course, don't have time to find new fraud patterns manually. So that's where also the semi-supervised approach helps quite a bit. So I think those three were the problems, and that's how we targeted those to help.
Excellent. And Paula, so Fintech OS is at a global scale and touches many different products across retail and business. Talk to us about how you're helping banks such as SocGen, corporate clients such as Vodafone, service their clients.
Right. So, well, one of the challenges that we see with these global players is that they have a huge legacy system and complexity in terms of their internal infrastructure and existing system. So it's widely spread and different across the different markets and countries. And also the fact that they need to react very fast to the ever-changing customer needs and demands, but also to the new players that are coming into the market. So the key differentiator that we work with them on is basically launching faster new innovative products to market. That means business users from their organizations can accelerate the innovation programs and create new products, financial products, either lending or insurance products really in a matter of days, and launch them through new innovative channels. So either we talk about web or mobile applications, or simply embedded and integrated into different players within the ecosystem, like merchants or telcos or different other partnerships that we see coming up in the market. But also another, let's say, challenge that they were facing is, well, you launch a new product, you have a new creative customer journey, it offers a seamless experience, which is also depending on the data that you integrate, how automated your underwriting processes are, and so on. But how you then can service those products, right? How you can integrate into the existing core systems that you have in place, how you enable self-service for those customers moving forward. So we are offering this fintech infrastructure layer that gives them the possibility to also service those products throughout their life cycle. And further down the line, to expand the relationship with their customers by creating new propositions. And again, create cross-sell or upsell campaigns and increase their value and their revenue streams. And we see different strategies that they have. So they either create their own marketplaces where they integrate partners from the ecosystem and create more value for the end customers, or they embed their products. For instance, with SocGen, we work with them in launching buy now, pay later type of products, or let's say credit cards integrated within e-commerce platforms cross countries, but still offering a unified experience for the end customer, as well as with their car financing dealer partners, or where they offer, besides financing, also insurance. So it's a unified experience for the end consumer, which doesn't have to actually focus on how they get the finance and the products, the protection that they need, but really on what the value is, what is the value that they are getting from.
Perfect. You know, one thing I wanted to go back to was leading with embedded finance and then how it segues into software. And Jeff, you know, I look at Ramp, and Ramp's done an amazing job with their card offering, and now is very focused on spend management software, and that's certainly in the news, especially with Thoma Bravo's buyout of Coupa, all the success that company has had over the last 20 years. Talk to us about why spend management software within B2B for Ramp.
I mean, who likes submitting expense reports, right? It's something that speaks a lot to people. It's also, as software becomes more consumerized, and what I mean by that is the bar for good software is extremely high now. People just wake up and they're realizing that, especially finance teams, they're forcing the rest of their company to use software that looks like it was made 20 years ago, and they look bad. They look bad. So they have a responsibility for the rest of the company to show that they're modern, that they're a modern finance team, and so we just focus on that. We focus on the fact that that we want to make our customers look like winners, and we want to make them look like champions in the organization. The other thing around spend is that every company spends very similarly. You know, there's T&E, right? Everyone goes to a conference, and there's AP, there's your bills. So that's very different than like other financial processes that are very unique to businesses. The way that LeadBank makes money is very different than how Ramp makes money, very different than how Fintech OS makes money. And so we started there, since it's uniform, since it's paidful, since it's high visibility. We get the stickiness by having both the employee and the finance teams using the products versus just one player. And then with that, we can then cross-sell more products over time.
Makes sense. So question for everyone on the panel, and something I've certainly been thinking about a lot, is this has been a challenging year. And over the past decade, the barriers to get a warehouse facility, to launch a charge card, to move money, to get access to the consumer, to get access to data, those barriers have consistently gone down over the last decade, and allowed many startups to launch and raise equity. Things are changing, right? So I'm curious, all of your perspectives. I'd be curious on the compliance and regulatory front. Like, is it going to be harder for new startups to launch now going forward?
I think the answer to that is yes. I think that spans multiple vectors. It spans, the cost of capital. It spans what you're seeing in the VC markets today, and it spans the regulatory environment. I think we're in a very unique position right now where those sort of three legs of the stool are all coming together to make it a lot harder and to really see a flight to quality. I think that that's where having innovation and the problem to be solved become incredibly critical, because where customer acquisition costs were something that no one was really talking about, the CAC to LTV, that's now top of mind for everyone across the bar. I think also we think about the regulatory framework we're facing right now, and I'll say, at least from my seat at LeadBank, we're very selective in who we'll take on as a partner, and we make sure that my team mocks me constantly, by the way, about my use of the word exemplary. They asked if I've actually tattooed it at this point. I have not, but it's early in the conference. But I think exemplary is the only way to really approach legal and compliance, and then to show the value add to our partners to ensure that not only do we understand their products and services, we understand their pain points, and we can actually be an accretive layer to them in their innovation, because I think that's where we're going to see the new up-and-comers really solving problems, doing something in a new and novel way, and creating those ecosystem effects. But we take it super seriously, and I think that anyone who used to view a strong compliance and regulatory function as an albatross is now starting to shift into really feeling that it's an asset.
I think there was a lot of easy money for the past few years, and that does create froth. It is hard to differentiate when everyone can claim the same thing, not have the backing for it. And so in some ways, I think the creative destruction that this is causing will be helpful for the truly innovative companies. Like if you have a differentiated product, if you have like the right CAC model, then I think you can survive. The key part is survive for like the next year-ish. Things will get better, and then you can grow from there. But I think if you don't have innovation to begin with, then maybe it's time to start looking at like what is the truly differentiated innovative solution that you're offering. What is the underlying problem you're trying to solve that people will be willing to pay for today, a year from now, 3 years from now? Generally, I see, if you look at history, most of the iconic companies get built through these hard times. And so take heart in that the company you are building could be one of those as long as you keep in mind the innovation aspect.
Mm-hmm.
If I can add on that, so though I fully agree, indeed, well, the capital markets have changed and there is a bit of a struggle, let's say. I think that only creates the best context for building the best partnerships and leveraging the expertise that both fintechs and incumbent or, let's say, expert players have in the market. And challenges even more all the companies to become more innovative and create new operational models, new risk models, how you approach compliance and regulatory while still simplifying the products that you're offering to your customers that are more relevant and that leverage indeed data, which is now today more available than ever. So it's more of how you identify in the end the infrastructure players, the enabler players that put together and orchestrate all these players in the ecosystem to create more value for the end consumers or small businesses, because in the end, I think financial institutions play still a very important role within the society in the end.
Totally. And this wouldn't be a panel if I didn't talk about the credit environment, interest rates. It is a very different time than the last 10 years, and rates being low allowed tremendous access to capital. I mean, Jeff, I'd be curious your opinion. How do you see this changing now for startups launching, and also startups that have been around for the last few years with a potentially deteriorating credit environment?
Yeah, I mean, I think it's been said, you know, with funding being way more scarce, you have less startups, therefore less innovation, less competition. The startups that already had pretty high funding rounds are looking at down rounds if they can't actually make financial progress, which was not in the cards for them necessarily for the first few years. I mean, the point is to take all that capital, invest in R&D, right? So it's going to be tough for a lot of folks. I think there's going to be a rude awakening. The opportunity there is, one, if you actually have a business model that works, you're going to have less annoying competition. Your CAC hopefully will be lower because people are spending less competing on the same, you know, the same type of channels that you are. If you are a bigger player in the space, great acquisition targets, incredible acquisition targets. I mean, you have extremely talented individuals who started their companies. We've had plenty from Ramp leave Ramp just to start companies, and these folks are great acqui-hire targets at a very low dollar amount. So I think there's opportunities there. I think for us, what matters is, you know, constantly repricing our products to make sure that we have the financials to mitigate changes in interest rates, which affect everyone, and that we have a much more embedded financial team. Strategic finance team in the product development process to help us advise on, you know, the balance between, you know, Horizon 3 R&D investments and Horizon 1 profitability investments. And I think that discussion oftentimes is more binary than it should be. So I think those things need to happen on the exec team. And
also, this wouldn't be a panel if I did not ask about AI and ChatGPT. So, but it is actually relevant to what we do. So I'd be curious, open question for the panel, you know, how do you see AI, machine learning, ChatGPT changing the risk management space for fintech and software companies over the next 5 years and its impact?
Yeah, I think we will use up the rest of the time fairly easily with this very interesting topic, right? So I think one thing that we have all realized now is about 40% of Americans are underbanked or have thin credit files. These could be young people, these could be minorities, immigrants, and so on, which is a very large market. 40% is a lot of people. And so there are interesting models to be figured out for scoring risk that goes beyond credit files and credit bureaus, right? And to be clear, like nobody's calling for death of FICO, like that's not the case. Those scores will be around, but it is time to have different revenue streams, different target markets, and have cash flow scores, have cash flow based underwriting, have pay prediction, income prediction that is separate from a credit file. And so there are interesting ML models that need to be built in that space for consumers as well as businesses. And so companies that do really well in those spaces would actually win. I think Slope is actually doing a great job on the business side of underwriting with these models. And so that's one example, but that's sort of the innovation that ML would bring to markets that were not very innovative in the past. The other bit that we see at ChatGPT is sort of giving power to the business experts, to the subject matter experts, to be able to get value from platforms and systems that they used to depend on engineers for before. So in plain English, they could ask for outcomes, like how do I solve this? Or what is the risk associated with this personality, given all this data we have about them? And ChatGPT is excellent at gathering a lot of this context, and in a zero-shot learning way, still give you the right answer that is reasonable enough in most cases. And so this will enable a lot more people to make decisions quickly and faster. And so this is a game changer in a dramatic way. I think the full impact of this we will see over the next couple of years and how much this changes entire industries. One example of sort of this generative AI trend I would give is, and this is slightly more on the fraud space, but interesting for everyone to know about this. We used to, so with Midjourney, DALL-E, and a bunch of these products, you're able to create a realistic image using one line of English text. Imagine how easy it is to create a fake ID, to create a fake selfie, to create a fake selfie video. And with a 3-second voice sample, now AI can have a full conversation with a customer support rep and convince the rep that it is the person claiming who it is. This is mind-blowing. This is going to open up the identity verification space. It's going to open up many of these fraud spaces in big ways. And we will need to find solutions as a society generally and as an industry, and specifically over the next couple of years, because fraudsters are not stopping. They are going to take full advantage of this technology. And so we have to be 2 steps ahead of them and find solutions to this. So this is a scary, but also a very exciting time that we are in this place. This is the truth. This is happening. The train has left the station. There's nothing else we can do. We have to find solutions.
And I think just to echo what you were saying, I love the idea that machine learning, innovation, and AI can open the aperture of products to serve the underserved. But I think we're also seeing that heavily in the regulatory and compliance spaces as these new technologies evolve and show immense utility. Fraud, KYC, everything has to shift to sort of meet the technology where it is, which unfortunately, a lot of times regulations don't keep pace with that. So that's, I think we came from a place where, these regulatory arbitrage pockets were great. And now we're like, we would love regulation. Tell us how to regulate digital assets. Tell us how to think about a digital identity footprint so that we can combat this in a holistic manner. But I think until we're there, explainability is always the biggest struggle in terms of, especially when you're using it for a credit decision, for a fraud decision, being able to actually defend what's going on and having that deep level understanding of how the tech works, I think is often a gap. And listen, I love ChatGPT. I think it's fantastic. But, that's really where I think we have a big hill to climb as well.
I kind of want to clarify one thing, or one way that I think about, GPT versus AI is GPT is like large language models that's trained on the intranet and maybe your internal data set. Supervised machine learning is way more powerful when you have a structured data set that has a predictive function, right? So when you think about a probability of default model, I don't think that you can beat supervised machine learning with a GPT-4 model. What GPT-4 or ChatGPT is very good at is understanding text. And so what we've applied it for are anything that requires operational work. Classic example is like OCR, right? Or any type of statement processing, or any type of summarization when you're underwriting a customer, and you want basically the GPT to say, who is this person? And they tell you and summarize all this information. So it's the automation piece, giving you structured data or even structuring unstructured data to then plug into your supervised machine learning models. And I think that, back to your example on fraud, I think you're going to have in the future basically AI talking to AI. And it's just a matter of, which model is more sophisticated. And so that's why it's really important to understand this technology and its applicability.
Great. One thing I've also been thinking about is we look at some very successful companies. Let's say Toast reported yesterday, amazing revenues, up their guidance, and they give a breakout of their fintech revenues, hardware, and software solution revenue buckets. So they've been successful from a go-to-market strategy front. So at the end of the day, there's a number of startups and publicly traded companies who have both the finance and software component, but you've got to have a good go-to-market strategy to bring in the revenue. So I'd be curious from the enablers on the panel, how are you evaluating and looking at these companies? Because of course, you want to deal with a company who has volume, right? And then Jeff, from your seat, it's a competitive space in spend management. What do you feel is differentiating you and Ramp on the go-to-market side?
Obviously, scale is important, and when we look at our customer base, we don't want one single concentration, though. One big customer, especially as we've seen in recent market events with regional banks, is incredibly dangerous. One concentration across industry. We want the spectrum. And I think this goes back to sort of where we started the conversation in terms of the flight to quality for newer stage startups. You have to approach it a little bit like with a VC mindset. Of course, you want the scaled companies that bring immediate revenue and impact your bottom line, but you also have to take bets. You always have to bet on the next thing that's going to be the successful one, and that's a little bit of the hard choices to make right now. I'd love to support every player that comes to our door and has a great product and a great team, but unfortunately, we're at that point where we recognize that a lot of these earlier stage companies may not make it through this cycle. So understanding the product and kind of projections are projections, they're just that, and cost of capital obviously sways those. But I think for us, figuring out the product and if we see the viability of it and we believe in the founding team is how we choose to make our investments and who we take on as partners.
So a few things on growth. Obviously, Ramp is very, very focused on growth, and we've done a lot there. There's key principles, like number one is define your target segment. Number two is define a budget that's co-owned between marketing and product-led growth. I'll talk mostly about SMEs and mid-market, less enterprise, which is much more sales-driven. And then have an experimentation approach as to how you're going to deploy that capital and measure the ROI, and then scale the things that have higher ROI. So it's really just an experimentation approach. I'll give an example. One of the biggest channels of growth from Ramp is our outbound emails. Turns out finance teams love responding to emails. Now they get inundated with emails, so how do you stay relevant? Well, the learning there was that you don't really create demand for your product. They either have that problem or they don't. And so it's about actually identifying the people that have that problem and finding them at the right time. And one of the perfect moments that works for us is when an accountant or a CFO joins a new company. And that trigger is actually perfect. It's like, hey, Joe, congratulations. can I help you be successful in your first 30 days and change things up? And it works. And so it's about testing and learning as quickly as possible and putting yourself in the customer's shoes and understanding what they're going through as a new CFO of a new company, and finding the right value prop for them to succeed.
Yeah, so I think the key is also in having value-driven partnerships. So you grow together with your customers. You enable them to access new channels, to launch new products, to create new revenue streams, or to simply become more efficient, more productive in the way they service their customers. So in any of these areas, it's all about how successful their companies are in the end, how they can service best their customers, grow their business, and then, of course, you are along their side throughout that journey. So it's always how you enable them to innovate, but fast, to keep up with the market pace, and then how they can transform their business while lowering also the expert knowledge required sometimes. Either you talk about IT or simply very high, let's say, professionals, right, with expertise on underwriting, on product definition, on journey definition, and so on. So you give actually power to the makers within the organization, which would speed up their transformation and then, of course, enable their growth.
Great. So I think we have time for one question. I'm looking at the clock. It's like 40 seconds left. A really good discussion. Any questions from the audience?
Kind of focused on lead bank here. As y'all expand your banking as a service, which really opens up a lot of the embedded finance solutions for other brands, how do y'all look at differentiating risk between what you're going to take to a balance sheet risk, or what you're going to take in terms of like exposure, new asset classes, things like that, versus what you're going to force onto the partner company, which might break them and lose the opportunity?
Yeah, I think it's a really good question, and it's definitely not an easy one. And so right now, it's very facts and circumstances dependent based on our own internal hurdles and what our balance sheet looks like. We did just acquire the bank in August of last year, so we're about $1 billion in assets now, and definitely looking to grow. But I think it is easier with more scaled companies where we understand what their IRRs look like and we can make informed choices there versus the earlier stage companies that probably need more support on 0 to 1 from sort of a funding and liquidity perspective. And I think that's something where there's actually a huge opportunity for us to have a really thoughtful approach to that. It hasn't been our top priority probably this calendar year, but it's something that we're looking to expand into to ensure that we're using our balance sheet in a thoughtful manner and in a manner that's obviously safe and sound, but also supports our partners as they're going from 0 to 1.
Perfect. All right, we're out of time. I really appreciate everyone attending. Let's give our panelists a round of applause.